Declining interest in margin shorts and a balanced risk perception in options markets highlight a possible path to $21,500 for BTC price. Bitcoin, BTC, showed strength on October 4th and 5th, posting a 5% gain on October 5th and breaking through the $20,000 resistance. The move liquidated $75 million worth of leveraged short, bear, positions, and it led some traders to predict a potential rally to $28,000. As described by Mustache, the descending channel continues to exert its pressure, but there could be enough strength to test the upper channel trend line at $21,500. The price action coincided with improving conditions for global equity markets on October 4th, as the S&P 500 index gained 3.1% and the tech-heavy Nasdaq Composite rallied 3.3%. Curiously, the sentiment improvement happened while the United States job openings dropped by 1.1 million in August, according to the U.S. Labor Department. The decline was the largest since April 2020 and signaled the U.S. Federal Reserve's aggressive contractive monetary policy could end sooner than expected. The overall bullish sentiment might have caused Bitcoin to break the $20,000 resistance, but that does not mean professional investors are comfortable at the current price levels. Margin traders did not increase their longs despite the rally. Monitoring margin and options markets provide excellent insight into how professional traders are positioned. Margin trading allows investors to borrow cryptocurrency to leverage their trading position. For example, one can increase exposure by borrowing stablecoins to buy an additional Bitcoin position. On the other hand, Bitcoin borrowers can only short the cryptocurrency as they bet on its price declining. However, unlike futures contracts, the balance between margin longs and shorts isn't always matched. The above chart shows that OKX traders' margin lending ratio has remained relatively stable, near 12. At the same time, Bitcoin price jumped 5% since October 3rd. Furthermore, the metric remains bullish by favoring stablecoin borrowing by a wide margin. As a result, pro traders have been holding bullish positions. Option markets hold a neutral stance. To understand whether Bitcoin will be able to sustain the $20,000 support, the 25% delta skew is a telling sign whenever arbitrage desks and market makers are overcharging for upside or downside protection. The indicator compares similar call, buy, and put, sell options and will turn positive when fear is prevalent because the protective put options premium is higher than risk call options. The skew indicator will move above 12% if traders fear a Bitcoin price crash. On the other hand, generalized excitement reflects a negative 12% skew. As displayed above, the 25% delta skew had been above 12% since September 21st. It did nosedive below that threshold on October 3rd, suggesting options traders are pricing a similar risk of unexpected pumps or dumps. Whenever this metric stands above 12%, it signals that traders are fearful and reflects a lack of interest in offering downside protection. Despite the neutral Bitcoin options indicator, the OKX margin lending rate showed whales and market makers maintaining their bullish bets after the 5% BTC price increase on October 4th. Derivatives seem to reflect trust in the $20,000 support gaining strength as investors display higher odds of the U.S. Federal Reserve easing interest rate hikes sooner than expected.